Okay, Chapter 21, Roth Plans. What is it? It's a form of the IRA that accepts contributions to certain limits on a non-deductible basis, and it provides tax-free withdrawals within certain time limits. So the net is, a Roth plan, you're taxed now rather than later. The concept is, in this case, you tax the seed, but not the harvest. This is tax-free when you withdraw the money. Similar to traditional IRA, you defer taxes on the income and the investments. It's used to accumulate long-term funds, especially for retirement. It's to supplement, to be an alternative to a qualified retirement plan. To use this when it's preferred to a traditional IRA, when the particular tax benefits under a Roth IRA are a better match for the individual's planning needs. The advantages: eligible individuals may contribute up to a specified limit annually, and withdrawals are tax-free. Two caveats are, number one, it's after a 5-year period, and, as in most things, death or disability, after age 59 and a half, and for Roth, it allows for a first-time home purchase. Could be for you or part of your immediate family. Also, Roth IRA contributions for eligibility is not restricted by the active participation in an employer's retirement plan like other IRAs. The IRA contributions can be made after age 70 and a half. That is not true for traditional IRAs. And they're not subject to require minimum distribution rules until after the death of the owner. And that is big, in that these days many people have a lot of money in traditional IRAs, and they're required to take required minimum distributions, which will and sometimes does push them into higher tax brackets. Therefore, when you have Roth monies available, Roth monies can be taken for retirement and will not trigger the additional tax brackets. Disadvantages: they're limited each year for each individual. It's reduced if the annual adjusted gross income exceeds certain thresholds. And early IRA Roth distributions, withdrawals, are taxed in full and subject to a 10% penalty. There are tax implications. Contribution rules, there are limits, so there is a maximum contribution is lesser of that dollar limit, or 100% of earned income, less contributions to traditional deductible or non-deductible IRAs. There's an AGA phase-out. Those were the limits in 2015. And these limits in 2019 are $122,000 to $137,000 for unmarried individuals. Married joint returns are $193 to $203, and for married filing separately, it is still $0 to $10,000. Time limits: Roth IRAs can be established any time prior to the due date of the tax return without extensions. And there are no restrictions made to the Roth after the taxpayer reaches 70 and a half. There is a saver's credit, limited non-refundable tax credits available to certain lower income taxpayers who make contributions to a Roth IRA. And employer-sponsored Roth IRAs, they can sponsor it for employees as a limited alternative to a qualified retirement plan. And employers can sponsor a deemed IRA as part of a qualified plan. And you can amend a Section 401k or a 403b plan so contributions and distributions are treated like a Roth IRA. There are distribution rules. You treat all Roth accounts as a single account when calculating tax consequences of distributions. So distributions are tax-free if made 5 years after the first contribution. 5 years is an important number. And on or after age 59 and a half, naturally, the death to a beneficiary or an estate, they're totally and permanently disabled, and for first-time home purchases. So for the Roth, you basically have three things: 59 and a half, death or permanent disability, or the first-time home purchase. If the Roth IRA distribution is not tax-free as a qualified distribution, then it's subject to federal income tax, and the total of the original non-deductible contributions are taxed as distributed first, and 10% early distribution penalty imposed on the taxable amount unless the distribution meets the exceptions. There are no minimum distribution requirements at age 70.5, but they are required after death. It must be distributed within 5 years of the owner's death unless there is a designated beneficiary. And if the designated beneficiary, the Roth IRA, can be distributed over the life or life expectancy of the beneficiary if begin distributions within 1 year of the decedent's death. Rollovers, you can roll over one Roth IRA to another Roth IRA tax-free. Must complete the transaction within 60 days. Remember, same thing true of the traditional Roth IRA, and only one roll over per IRA within a 12-month period. Cannot roll over the Roth IRA to a traditional, a qualified plan, or a tax-deferred annuity. Traditional IRA or qualified plan, or part of one, can be rolled over to the Roth IRA. The IRA or qualified plan taxable as ordinary income in the year of conversion. So true or false? Alice, age 60, has a 6-year-old Roth. Alice can withdraw her initial investment and all investment income and gains tax-free. So the issue is it's over 5 years, over 59.5. Therefore, she can withdraw it, and the income and gains are tax-free. That's true. Question 2, unlike a traditional IRA, no withdrawals from a Roth IRA incur a penalty tax. Well, that is false. There would be a penalty tax, wouldn't there, if 5 years has not been met, before 59.5, or other reasons if it did not have the exception of the first-time home purchase. So that is false. Number 3, amounts contributed to a traditional IRA reduce the amount available to contribute to a Roth. And that is true. It's the total amount of traditional and Roth IRA contributions that are combined for the maximum amount. Number 4, the first-time home buyer exception can be used anytime the individual or her spouse does not own a principal resident within the preceding 2 years, and that is true. That is one of the exceptions. True or false? Number 5, a Roth IRA can be rolled over to a traditional IRA. That is false. It is the traditional IRA that can be rolled over to the Roth. If a taxpayer is eligible for the maximum annual contribution to either a traditional or Roth IRA, which should be chosen? As the textbook points out, actuarially, they are equivalent. However, that's making the assumption that the savings from the traditional IRA is not invested. From a practical standpoint, it's important at retirement to have both Roth and traditional IRA monies. Therefore, from a practical standpoint, there should be dollars in both the Roth and the traditional IRA buckets. 2, is it advisable to convert a traditional IRA to a Roth IRA, assuming that the $100,000 AGI test has been met? As in everything else, it depends. Number 1, if you convert a traditional to a Roth IRA, you must pay taxes on the conversion amount. Tax-wise, it may depend on the marginal tax bracket you are currently in and what tax bracket you may be in the future, along with the expected income tax rate. In many cases, it is important to have both Roth IRA money and traditional IRA money. If the traditional IRA required minimum distributions are so large to push you in an additional tax bracket, then you may have been better to have had Roth IRA money to withdraw, which is not taxable. Again, as in anything else, it depends.